Hi everyone, welcome to the channel. Today we're going to talk about dividend stocks and what are the opportunities and risks embedded with this kind of investment. But before we jump into the video, please press the subscribe button down below and join the community. Let's start introducing what are dividend stocks. A dividend stock is a company that pays out part of its yearly profits in the form of dividend back to its shareholders. Different companies may decide on the timing of the issuance of their dividend. Some pay it monthly, some quarterly, some others yearly. In this regard, there are ratios that allow analysts to screen for dividend stocks that fulfills certain characteristics. One of the most important is the dividend yield, that divide the dividend by the current stock price of the company. In brief, dividend yield allows for screening companies that pays higher rather than lower dividend compared to the peers. Higher yields imply that this specific company is more attractive to a certain type of investor, interested into having a consistent income stream from dividend into their own pocket. High-yield dividend companies pay out a higher portion of their net profitability in the form of dividend. In contrast, low-yield dividend stocks pays out a lower portion of their earnings in the form of dividend. Clear, right? Long story short, dividend stocks provide investors with a predictable income source over time. In 4 words, source of passive income. A passive income revenue stream that can even grow over time. There are multiple benefits of investing in dividend stocks. First of all, they provide a predictable income stream. Dividend stock provide a steady stream of income that can be used to supplement your retirement income, pay off debt, or simply save for a rainy day. On top of it, they provide growth potential. Companies may increase their dividends over time, which can lead to capital appreciation. Dividend reinvestment plans also are part of the benefits and allow for automatically reinvest your dividends in more shares, and this can help you compound your return over time. Lastly, they can support diversification, since dividend stock can be a good way to diversify your investment portfolio and reduce your risk. Dividend stocks can be a valuable addition to any investment portfolio. They can provide a steady stream of income, growth potential, and diversification. Now let's make a quick example just to give us a bit of flavor regarding what we are talking about in terms of cash flow. If you aim to get at least $1,000 monthly out of your investment in dividend stocks, it means that you aim at something like $12,000 per year. Well, now imagine a company that pays a 5% dividend per year. That is not bad at all on average. In these regards, you need to invest in dividend stocks at least $240,000 ex ante. Not really peanuts, right? Note also that you have to deduct taxes and potential brokerage fees on your investment. So all in all, your return will be substantially lower. So to reach your goal, you better increase the capital invested or look for yields higher than 5%. A comparable could be 6.6% yield to have the same result. My personal tip to select your champion is to leverage on a dividend stock screener and maybe implement also additional indicators in our research, such as the debt to equity ratio or the compounded annual growth rate, to appraise how the business is expected to perform according to the previous track record. Until this point in time, everything looks easy, sunshine and rainbow. But what are the real risks in investing in dividend stocks? So, first of all, let's say that dividend payments are not guaranteed, and everything can change anytime. Second, market fluctuations are behind the corner and by definition are unpredictable. Third, you cannot rely 100% on dividend stocks because of the aforementioned issues. Fourth, the inflation can erode your dividend income. meaning that you have to select an investment that manages to cope with inflation, and one of the options, sorry to say, is that you have to increase your risk tolerance. Just to add a positive note, we can say that by diversification and appropriate analysis, we can mitigate quite substantially all risk embedded with the investment in dividend stocks specifically. Now it is time to make a screening of the classes of dividend stocks out there. First of all, we can differentiate dividend stocks according to the payout ratio, whereas we have high yield, moderate and low yield companies. In detail, high yield dividend stocks pay out a higher percentage of their earnings in dividends. They may be riskier than other types of dividend stocks, but they can also offer the potential of higher returns. Then, moderate yield dividend stocks offer a balance between dividend yields and growth potential. They may be a good option for investors who are looking for both income and growth. Low yield dividend stocks are usually paying out a lower percentage of their earnings in dividends. They may be more risky than moderate yield dividend stocks, but they may offer also the potential for higher growth. Then we can further differentiate according to the growth potential. In this case, we will have dividend kings, aristocrats, growers and capture stocks. Hold on a second and let's have a look. We have first of all dividend aristocrats, and these are companies that have a history of increasing their dividends for at least 25 consecutive years. They are considered to be among the safest and most reliable dividend payers. The top class of this category is referred as dividend kings, and these are companies that have a 50-year streak of uninterrupted dividend growth. They are even rarer than dividend aristocrats and are considered to be the crème de la crème of dividend-paying companies. Another category is identified as dividend growers, and these are companies that are growing their dividends at a faster rate than the general market. They may be riskier than dividend aristocrats or kings, but they could offer the potential for higher returns. Lastly, we have the so-called dividend capture stocks. These are companies that are expected to pay out a special dividend or a one-off distribution. They may be attractive to investors who are looking for a quick boost to their income. It's worth mentioning that regarding dividend aristocrats, they came out as outperforming stocks even during the worst recession, whereas they have consistently outperformed the overall market. This is given by their resilient business model and a strong financial footing. Even during the worst recessions, dividend aristocrats managed to deliver a steady source of income to their shareholders, even in challenging market conditions. In 2008, for instance, the overall market cap of dividend aristocrats declined by 22%, against an overall drop of the S&P 500 of more than 35%. This highlights the ability of dividend aristocrats to weather economic downturns. In brief, we can say that the outperformance of dividend aristocrats is a proof of a rock-solid business model behind, providing them with a clear competitive advantage. Lastly, we can differentiate by risk. The top notch is given by the blue chips, which are the safest. Then we have value stocks, and lastly we have growth stocks. Let's have a look. Blue chip stocks are those stocks of large, well-established company with a long history of profitability, and they are considered to be a relatively low-risk investment. Then we have value stocks, and these are stocks that are trading below their intrinsic value, and they may be more risky than blue chip stocks, but they could offer the potential for higher returns. And then we have growth stocks. These are stocks of companies that are expected to grow their earnings at a faster rate than the general market. They may be more volatile than value stocks, but they could offer also the potential for higher returns. Concluding, when we come to different stocks, you have to select your holdings depending on your risk tolerance and your risk appetite. For instance, if you aim for a consistent revenue stream into your pocket, you may look at high yield growth stocks, but this comes at the cost of a higher risk profile. So you're gonna take over more risk. In contrast, if you aim to have a steady income without risking too much of your capital, maybe it is the case that you direct your attention to blue chips or value companies with a medium expected return. So we reached the end of the video, I hope you enjoy, but before leaving us, press the subscribe button down below and the bell. And hold on a second, I was almost forgetting, just in case you are interested into the psychology driving the market, buy this book, Irrational Money, written by myself, that explain how to exploit the psychological biases on the market to take advantage of them. Cheers!